Good morning. My name is Greg Upton. I'm the Executive Director and Associate Research Professor here at the LSU Center for Energy Studies. Welcome to our 2025 Gulf Coast Energy Outlook Kickoff. We especially welcome those of you who might not be familiar with the Center for Energy Studies, or CES as we call it. CES is a unique research unit at LSU and that we were created by the legislature in 1982. We provide energy information and analysis that responds to the needs of the legislature, public agencies, business and civic groups, as well as the general public. And the annual GCEO is one way that we fulfill this mission. The majority of our funding comes from the legislature through LSU, and we also participate in funded research through federal and state agencies, as well as private companies. We pride ourselves in our diverse constituency and funding sources, which allows us to provide analysis without a political or economic agenda. We also thank CES's sustaining members from across the energy value chain, including at the platinum level Air Products, the Baton Rouge Clean Air Coalition, Entergy, ExxonMobil, Oxy, and Shell. At the gold level, Chevron, ConocoPhillips, Phillips 66, and Talos Energy. At the silver level, we thank CLECO, Drax, which is now in the U.S. arm, which is Elimini, Jones Walker, Placid Refinery in the Baton Rouge Area Chamber. At the bronze level, we thank American Electric Power / SWEPCO, the Southwestern Electric Power Company, Harris DeVille and Associates, Koch Industries, Louisiana's Department of Energy and Natural Resources, as well as the Louisiana Oil and Gas Association. And at the contributor level, we thank Iser Amper, Keen Miller, Louisiana Economic Development, Log Exploration, and the TJC Group. If your organization is not on this list, please consider becoming a CES sustaining member at any time. I'd also like to thank the dozens of individuals from industry, government, and trade organizations, as well as academics, that spent their valuable time speaking with us this fall in preparation of the year's outlook. I see many of you here on the webinar today. While crunching the numbers and the modeling, of course, is very important, equally as important as this input from the stakeholders, the outlook just wouldn't be possible without you, so we're very appreciative. I'm also super excited to recognize our two new co-authors on this year's report. First, we have Chris McLindon, who has over 4 decades of experience as a geologist and joined CES as the Director of Energy Education and Outreach this past year. Chris has contributed to the upstream oil and gas portions of this year's outlook. Second, we have Andrew Owens, who retired from Entergy at the end of 2023 as the Director of Regulatory Research and Strategy and joined CES as a research fellow this past year. Andrew contributed to the electricity section of this year's outlook. I've spoken with Chris and Andrew for many years in preparation of the outlook, and so it's been a pleasure and really exciting to be able to work with you directly on the report this last year. Also, Emeritus Professor and former Executive Director at CES, David Dismukes, continues to be a co-author on the report, but couldn't be here today for the kickoff due to a traveling conflict. So now a very brief agenda for today. I'm going to start off with discussing the uncertainties and modeling assumptions that we use in the outlook. We're then going to move into the different parts of the energy value chain. We'll begin with Chris to discuss upstream oil and gas. We'll then switch over to Andrew, who will discuss the electricity markets. We'll then switch back to me to discuss the industrial developments, energy exports, and finally, the employment forecasts. If you have any questions throughout, please type them in the Q&A on Zoom at any time, and so you can type them as they come about, and we'll try to leave time at the very end in order to get as many of those questions in as possible. As you do consider asking the question, please keep in mind that the webinar is recorded and will be posted on our website after. The Outlook document itself is on the center's website and has also been put into the chat. So please take a look, and it provides additional information around the discussion today. And there are also many more slides that we looked at and considered in preparation of the outlook that will also be posted to our website shortly. So without further ado, let's get into the intro and uncertainties. So every year as we talk with different stakeholders, what I do is I take notes and I kind of put the different things that people tell me into different buckets. So I ask people, first of all, how's business? How's this past year been? And what do you see for the upcoming year? But I also ask people about what are the uncertainties that you see out there, and as well as the opportunities. And I kind of aggregate these into this list right here. And of course, over time, some new ones come up and some stay consistent. So the big one, of course, unsurprising this year was the presidential election. So we'll talk about that. Less so than last year, there was really a lot of talk about the economic outlook. That certainly was talked about this year, but of course, the presidential election kind of superseded that. A consistent theme of these outlooks has been these decarbonization efforts and really balancing this cost competitiveness and emissions reduction. So I'll give some updates on that. And then the fourth, I think, really new thing this year that I think people are talking about increasingly is, are we entering into a new era of electric demand growth? And so I'll talk about that a little bit, but also Andrew will talk about that a little bit as well when we get into his section. So presidential election, there are kind of three big points under here. Number one, will federal programs and subsidies under the IIJA as well as the IRA continue? So this is a good question. There's a lot of kind of concern of, hey, look, maybe there's this project that's moving forward. If you were to change the tax structure, change the subsidies that are there, could that really negatively impact some of the projects moving forward in Louisiana? I was actually in Washington, D.C. earlier this week and talking with several congressional offices and asked this exact same question. And kind of the answer I got is that the leadership now is looking at taking a scalpel to the IRA, but not really knocking it down or redoing it completely. So could there be some tweaks? Of course, there could be. But our kind of assumption is that these subsidies continue and the IRA and our IIJA continue. The second big thing is international trade uncertainties. So if you've watched this outlook in prior years, you know that whenever Trump was elected the first time, we talked a lot about the China trade deal. So we had phase one of a trade deal that was negotiated with China, and President Xi and President Trump signed that trade deal. And then we watched whether or not China was living up to that agreement. And going into the presidential election between Trump and Biden, what we saw was that the phase two had kind of been delayed until after that election time period. When President Biden won, phase two of that was never signed. One of the things that Trump said publicly on the campaign trail was that China and President Xi did not fulfill that trade deal, and therefore this would be something brought up if he were to win again. So that will be a big question. When I've talked, and I'm not an expert on trade by any means, but when I've talked to people that really study this international trade, what I've been told generally is that although the rhetoric of Trump was very different than Biden's, when Biden came in, there was really kind of a continuation of a lot of these kind of protectionist trade policies. And one example of that was the protectionist trade policies within the IRA. And in fact, China actually filed a complaint with the World Trade Organization about those trade policies. So in practice, we'll see what happens. Of course, rhetoric can change. Our assumption is that trade policies kind of stay standard in our forecasts. And then the third is the end of supply restricted policies. Again, prior listeners of the Outlook know that the LNG permit pause, as well as the offshore leasing pause under the Biden administration, got a lot of critique from people in the energy sector. And so one thing that I think that people are excited about is kind of this all of the above energy strategy, and likely to see less of these supply restricted policies. So the results of the actual election actually concurred with the finalizing of the GCEO, of finishing our phone calls and doing all the modeling. But as in all prior GCEOs, the current policy regime is assumed to continue until a policy actually changes. And so, the kind of baseline scenario is that IRA subsidies continue, international trade, keeps about the same policies, and that these supply restricted policies likely will not continue. All right, so next let's talk about the economic outlook. So 2 years ago, when we were in this outlook, everyone was talking about a recession. It was almost as if a recession was imminent. And as you can see from this graph here, this just hasn't happened. U.S. employment, of course, we had the dip during the pandemic. Estimate lost about 14% of U.S. employment, but we have grown and continue to grow out of that. And so there's kind of a joke. We say the stock market has predicted 9 of the last 5 recessions. You saw that dip in the stock market. The stock market, of course, now has bounced back. And employment continues to rise. Why was everyone forecasting a recession? Well, it was because you had inflation during that time period was outpacing wage growth. And so when you have inflation outpacing wage growth, there's this concern that this could lead to a contraction. Fortunately, today, inflation has now slowed back down. We have wage growth, which is outpacing inflation. And so, so economically, there's I guess less concern about a recession today. Not to say a recession could happen at any time, but right now that is not the baseline scenario. So prior watchers of the outlook know that U.S. energy consumption has really been really steady in the United States over the last decade and a half. And actually, the demand for energy in the U.S. is actually forecasted to be relatively steady moving forward. But of course, and this is a graph that shows the relationship between primary energy consumption per capita as well as log GDP per capita. And the thing that I want to highlight here is here in the United States, of course, we have a very high GDP per capita and a lot of energy consumption per capita. But the really growth in energy demand that we see, which is really crucial to all of the outlook, is really this developing world. So you see China and India there, two very large developing economies. As they move up and have economic development, their energy consumption almost certainly will increase. And so what we're really seeing here is we're really seeing that the demand for energy globally is likely going to rise in coming decades. And so it's really that long-term energy demand growth, which we see coming from the developing world, which really drives the economic activity here in the Gulf Coast region. So this year's GC modeling assumes that wage growth continues to outpace inflation, and demand for energy globally will continue to rise. And much like themes in past years, we see long-run energy demand growth leading to increase in U.S. energy exports, especially to this growing developing world. So that's our economic outlook for this year's outlook. Third, which is decarbonization efforts, balancing cost competitiveness and emissions reductions. This has been another year of this just being a central topic to many of the conversations that we're having. So as many people know, in Louisiana, over half of our emissions are industrial emissions, and you can see right there, that's very different than the rest of the U.S., for which industrial emissions are a third place to transportation and electric power. Here in Louisiana, it's really the industrial emissions that are the big part of that. So for us, when we talk about decarbonization, what we're really talking about here is these industrial emissions. The good news is that emissions intensity of GDP has declined precipitously in the United States over the last half century. In fact, it's dropped in about half, so that's really good news. But if you look at our emissions intensity relative to the rest of the world, so you look at our competitors, for instance, our OPEC competitors, which are there in green, we have a very, very good emissions intensity relative to those competitors. And so our emissions intensity is relatively low, which is good news for us as we sell to these global markets that are asking us to document those. When you look at just a bunch of countries, we're kind of in the middle of the pack. But of the G7, and we're actually kind of on the higher end. So you've got, you got France, UK, Italy, Germany, and Japan all have a lower emissions per capita. Canada actually has higher than us. So this is really the balancing that we're seeing as all these countries are going this downward trend in terms of their emissions intensity. And we're kind of in the middle of the pack there, very competitive relative to OPEC, and kind of in the middle of the pack nationally. So why does this matter? Of course, right now, Europe is going through its carbon border adjustment mechanisms. I got to go on a trade trip hosted by GCEO Inc. and H to the Future earlier this year to Belgium to talk with the Europeans about importing low carbon energy from the United States. And a key theme of that trip was really talking about CBAM, these carbon border adjustment mechanisms that are being rolled out in the EU right now. We also had a few weeks ago, Senator Cassidy had a really wonderful event here in Baton Rouge, talking about his plan to think about China's growing influence and how we think about trade policy at the same time of thinking about these emissions policies. And so as we sell these products into the global marketplace that are lower emissions intensity, we've dumped billions of dollars in subsidies into these different production of these low carbon products. And so how do we think about that when we import these emissions intensive products? Could we perhaps tax those? And so a key theme here is emissions being tied with trade. And of course, the different strategies for that are different, but that's something that companies are increasingly thinking about. So we see decarbonization will continue to challenge existing Gulf Coast energy manufacturing, but it'll also create an opportunity for the regional leadership in the development of liquid fuels, chemicals, plastics, fertilizers, and all these other products which have historically been derived from fossil fuels with lower greenhouse gas emissions. Right now in the Louisiana legislature, of course, we have the hydrogen task force as well as the local impacts of CCS task force that have been fundamentally talking about this issue. Long-term effects of decarbonization on the region will be determined by the cost to achieve these emissions reductions alongside, and this is so important, the global market's willingness to pay a premium for these less emissions intensive products. So in the short run, we see a lot of economic opportunity from these decarbonization investments. But in the long run, this is an opportunity, but I think it's also a big risk for our region because we sell these emissions intensive products to the world. All right, and then the final one is a new era of electric demand growth. And again, Andrew's going to talk about this in a little bit more detail. But when you look at world electricity demand, it is projected to grow into the future. When you look at U.S. generating capacity, you can see that's expected to grow into the future, and this is being talked about a lot. This is analysis from NREL. And so one of the questions that we asked is we said, okay, as I've gone and spoken to the outlook throughout the year, and we've always talked about this kind of domestic energy demand being flat, production being growing, and therefore this facilitating exports. And one of the questions I've consistently gotten this year is, wait, but I've heard that electricity demand is going to increase. How does this kind of jive with that story that we've told for years? So we went and did an analysis with 3 different things. Number one is we considered electric vehicles, the second heat pumps, and the third data centers. And of course, we had that big data center announcement here in Louisiana just very recently. And we did the following exercise. This is not to be a projection, but it's just meant to be a kind of exercise to say, okay, what if every single light duty vehicle in the United States were to switch from an internal combustion engine to a gasoline engine? What would this do? What would be the increase in electricity demand relative to the current, the most recent year's electricity demand? And you find that that would account for about a 30% increase. So that's a large increase. Of course, I don't think all the vehicles are going to move to electric vehicles, but that kind of gives you perspective on what that would look like. But interestingly, when you consider the efficiency of an industrial scale, for instance, combined cycle natural gas unit, its heat rate compared to an internal combustion in a car is way, way, way better. Now, you do have some line losses whenever you send that electricity to the final consumer. But in net, what's interesting is the number of BTUs, the total energy use in the economy to drive a mile with the electric vehicle, is actually lower than for the internal combustion engine. So even if you have an enormous adoption of EVs, the conclusion here is that although electricity demand will go up, total BTUs of energy actually could go down. We see a similar thought exercise here with heat pumps. We've considered, what if all residential and commercial properties were to move to heat pumps? Again, we're not projecting this, but what would this mean? That would account for about 11% of total electricity consumption, but again, 4% less BTUs. And then we took a really nice study by EPRI, the Electric Policy Research Institute, which does a lot of great work. And we took their most aggressive data center growth, and that accounts for about 6% of electricity generation, or about 0.9% or 1% of BTUs. So we anticipate that the share of energy in the U.S. economy coming from electricity is likely to increase over the coming decades. The net effect of that in the long run on total energy usage is ambiguous, but again, we're kind of projecting kind of flat total BTUs, but the share from electricity likely is going to increase. And we can see that here. This is consistent with the International Energy Agency and their World Energy Outlook across the world. So GCEO anticipates share of energy in the U.S. economy from electricity to increase over the coming decade, but much like past years, anticipates long-run energy demand growth that will lead to U.S. exports, especially to that developing world. And at this point, we're now going to switch over to Chris to talk about the upstream oil and gas forecast, or the upstream oil and gas piece of it. Chris?
Thank you, Greg. Good morning, everyone. U.S. oil and gas production curve is not dissimilar from the employment curve that Greg showed. There was a clear impact of the pandemic, but both U.S. oil and natural gas production have increased since then, both having passed their pre-pandemic levels. World oil and gas production has also increased following a similar pattern, but significantly the U.S. share of that production, I'm sorry, this is crude production. The U.S. share has been on a steady increase. The inflection point of that gold curve marks the widespread use of the dual technologies of horizontal drilling and hydraulic fracturing in the U.S. In the Gulf Coast, the pattern follows a similar one to the U.S. total, but they did climb out of that pre-pandemic level a little quicker. The U.S. rig count has generally tracked prices, but you can see there's a progressive downward step. And over the last 2 years, there has been a decrease in the rig count. Comparing that to the increase in production is indicating that we're getting more oil and gas with fewer new drill wells. In Louisiana, the significant impact here was the price crash in 2015, which affected the number of oil completions significantly. They have not recovered to the previous levels, but natural gas completions coming primarily from the Haynesville have been holding fairly steady. In the shale basins, you can see the overall rig count pattern is very similar to the U.S., and this is being driven primarily by the Permian. So it is the shale basins that are driving rig counts, and the Permian is a primary contributor to that. Similarly, for crude oil production in the regional area, the Permian is the primary driver. Gulf of Mexico OCS, which is entirely deep water, has been a steady contributor and will continue to be so. The Haynesville has continued to rise over the past decade, but has shown a decrease in the last year. And we'll see that's probably a response to prices. We'll see where that goes going forward. And you can see the Haynesville is a significant contributor, has been a significant contributor to natural gas production in the region. It and the Permian Basin are really driving natural gas production for our region. We look at historical prices in epochs. You can see the dark horizontal lines are the average prices for each of 3 epochs for oil and natural gas. The 2 lighter lines are one standard deviation above and below that. And I'll just point out 2022, there was some thought after the Russian invasion of Ukraine, maybe we were entering a new price epoch there when it jumped up, but the prices in both settled back down or are within the standard deviation for the epoch as a whole. Projected prices for both oil and natural gas. For oil, you can see the 3 curves are 2 previous years' projections along with this year's. It's been consistent and appears to be projecting out fairly consistently into the future. The 2022 gas forecast was a little higher in response to the Russian invasion of Ukraine, but that has decreased in successive years for future projections. And significantly for crude oil production in the U.S., the Gulf Coast share has been significant. So relative to the rest of the U.S., the Gulf Coast is really driving the increase in crude oil production for the U.S. as a whole. With natural gas, we're a little more in line with the rest of the country, holding a fairly consistent share going forward. And these projections are from the Enverus Prodcast model, which we incorporated into the Gulf Coast Energy Outlook.
All right, so with that, now we're going to switch over to talk about some midstream constraints quickly. So this is a graph for people who have seen the GCEO in the past that's very familiar, where we show that the price difference between West Texas Intermediate and Louisiana Light Sweet is related to the share of oil that's being shipped by rail and tanker. And what's good news is right now prices kind of seem to be within equilibrium within the United States. So not a lot of constraints are there. Of course, as you have growth in production, you can have some build out, but markets are in kind of equilibrium. When you look at international markets, we're actually seeing projected out that Brent will be a little bit of a premium to WTI, which is actually good news whenever you think about, again, that export opportunity. So as we export these products to the world, if there's a premium internationally, that's going to drive the production and then therefore the export here. You can look at the difference between TTF, so this is the Tidal Transfer Facility in Europe, the JKM, the Japan Korean marker, and the Henry Hub for natural gas. And again, what do you see here? You see prices internationally higher than prices domestically. And so this is one of the things we look at, especially when we're thinking about LNG exports, but also with the competitiveness of our chemical sector that uses these natural gas and NGLs as a feedstock. And so this is a good sign when looking at the competitive of that sector internationally as well. And as we can see right now, we've got different projects going on in terms of, this is from EIA, the natural gas pipeline projects. And so there's active pipeline construction that's going on. And from there, we will now switch over to the power sector for Andrew to talk about.
Thanks, Greg. Appreciate the opportunity to speak this morning. So first, we're going to talk about total electricity sales in the U.S. As Greg noted earlier, there's been fairly flat sales for really the last 15 years. However, you also see the Gulf Coast share has escalated in the last 10 years, and that's really driven by the activity on the next slide, which is industrial sales. If you go deeper into the data, looking at industrial sales, while the U.S. has been flat for the last 15 years, really go further back even than that, it's been flat. You really see a change, though, reflected by growth in the Gulf Coast states. And just as a reminder, the Gulf Coast states are Louisiana, Texas, Alabama, and Mississippi, the Gulf of Mexico share. So that's largely driven by Texas and Louisiana, which we'll talk here in a second, some of the drivers. If you could go. Yeah, Greg mentioned the thought exercise around electrification, heat pumps, electric vehicles, and data centers. And he noted the announcement about a month ago, but much more data about it in the past couple weeks. So Meta has announced a new data center to be constructed in North Louisiana. Notably, this will be the largest data center they have in the world. If you look at a filing made by my former employer, Entergy Louisiana, about a month ago, much of that is redacted, but you can derive a little bit from some assumptions, the scale of this facility, which is just massive. And so Greg's thought exercise about data centers was a U.S. view. If you look at just this data center relative to Louisiana, you make some conservative assumptions. This might, when fully constructed, increase electricity sales in the state by somewhere on the order of 15 to as much as 20%. So when you think about it statewide, it is an enormous number. This will be the largest customer of electricity in the state by multiple times relative to anyone else. So think refining, think petrochemicals. The scale of this facility is just remarkable every which way. With that, another driver is electric vehicles. You see the trend from 2020, rapid adoption as more models become available. That has started to flatline a little bit in 2024. A number of drivers for that, including just cost, interest rates, borrowing cost, a number of factors. As time goes on, we'll see what happens both in the U.S. and then particularly Louisiana with adoption of electric vehicles. We'll see what happens from a policy perspective at the federal level. There certainly are thoughts that some of the tax credits that were put in place with the Inflation Reduction Act might be clawed back or altered, but remains to be seen what Congress and the president will do in early 2025 as far as adoption. If you look at changes in electricity generation, some notable trends. So coal continues to decline. That's the bar at the bottom. You go back, it is, as a share of U.S. electricity generation over the last 20 years, fallen from 50% to about 15%. What's taken its place is growth in natural gas generation and renewables, principally wind and solar. Hydro and nuclear have been fairly flat over the decades. We'll talk in a slide or two about the growth that is coming, along with the drivers like EVs, electrification, data centers, manufacturing. So looking at rates, industrial rates from 2008, when the 2008-9 recession hit, till about the beginning of the pandemic were very flat across the US and in the Gulf of Mexico, which has had the advantage of lower than national electric rates. In 2022, you saw the spike with the invasion of Ukraine and natural gas prices that were reflected in electric rates. You've seen prices start to come down. There has been some divergence, though, among the Gulf Coast states. And if you go to the next one, you'll see the breakdown. This shows all 50 states, excluding Hawaii, which if we had Hawaii on the state would jack the graph all the way up. So omitting the state of Hawaii, you see where the 4 Gulf Coast states fall. You see Louisiana in 2023 had the second lowest average industrial electricity rates. Many drivers for that, natural gas being one. You see Texas a little bit higher. That's often the state that we're compared to. Alabama, Mississippi are a good bit higher. If we were to look at sales across those 4 states over the last number of years, Texas and Louisiana have both seen increases to their industrial electricity sales. Alabama and Mississippi's have actually declined. Alabama's have declined the most. Some of that may just be the nature of industry in the state. Some of that may be price competitiveness being reflected in how large industrial manufacturers decide where to allocate capital and growth. So 2 more quick slides. Looking at CO2 emissions, the industry as a whole continues to reduce emissions. A lot of that is going to be driven by retirements of coal units. Some of that is renewables that are displacing fossil generation in the dispatch stack. Looking at growth first at the United States level, a lot of what in the past couple of years is now being reflected in plans by utilities and independent power producers to add natural gas, to add a lot of wind, to add a lot of solar. You see pretty significant numbers. You continue to see coal retirements. There's not much expected as far as nuclear and hydro other than a fairly static view. Although we'll see there's a lot of developments around advanced nuclear where maybe in the coming years we're going to see further investment and growth in that sector. When you look at the Gulf Coast on the next slide, you'll see the story is even more dramatic. A lot of that is led by Texas, followed up by Louisiana, of growth in industrial sales from data centers, from in Texas crypto too, as well as electrification, commercial, residential, and electric vehicle adoption, reflected in the need for additional generation, much of which is going to be gas and renewables for the foreseeable future. With that, I'll turn it back to Greg to continue the discussion.
Thanks, Andrew. So next, we're going to switch to the energy manufacturing, which is the analysis that David always puts together. So here you can see the Gulf Coast energy manufacturing investments broken down by category. You've got LNG exports, cracker polymer, methanol, ammonia, other, and then what we have these transition investments, and that's going to include a lot of hydrogen, CCS, and those kind of things, and bio-based feedstocks, biofuels. So as you can see, and 2 years ago is when we initially added this as the transition investment as one of the categories in here, and that has consistently grown. And so what's really interesting here is we now see that about 36% of the announcements that are out there are energy transition related investments. I'll make a note that these are all of the announcements and the kind of the timing of when those announcements say that these investments are going to occur. Note that typically, of course, not every single investment happens, as well as some are delayed. They don't happen on schedule. But the good thing to take away here is there are a lot of announcements out there. And that, of course, is going to be really important when thinking about what our employment forecast is in the refining, chemical manufacturing sectors. Interestingly as well is that, we have about half of the investments so far have been in Louisiana and half in Texas. And this is really important for Louisiana. Is of course, we have lots of employment in these sectors. So Texas, of course, has a larger sector. But if you look at the relative share, this has really been very important for us here in Louisiana. And here are the numbers that David compiled. So we got between 2011 and 2023, we have about $258 billion of investments within these sectors, approximately half of that within Louisiana. And there are currently another $220 billion of announcements, again, about half in Louisiana. And so this is a big indicator of continued growth in the employment within these sectors as you make these capital investments. We got energy exports. So again, a consistent theme throughout the outlook, which is that this domestic energy demand has been relatively flat, growing demand globally, which has facilitated these billions of dollars of investments and export all these over the world. And this is a nice graph from the International Energy Agency from their World Energy Outlook that projects total energy usage, again, globally, really growing over time. And in the U.S. actually being flat over the next 5-6 years, and they actually have a pretty sharp decline after that in their projections. But the big thing we're looking at is international demand growth. So we can see here we've got crude oil exports right here. So we're still a net importer of crude oil, but of course we refine that here in the U.S. And as you can see here, now we're a big net exporter of these refined products. And so the net imports have kind of remained a little bit flat over the last few years, but we continue to have an increase in the amount of these refined products, which is showing that we're having the manufacturing here in Louisiana. We're taking that oil from all over the world. We're then creating all these products and then exporting them globally. On the LNG exports, you had the peak there after the Russian invasion of Ukraine, but we're consistently seeing 11, 12, 13% of U.S. production being exported, of natural gas production being exported in the form of LNG. And this was reflected again by the prices in Asia and Europe being significantly higher than here. So we see LNG exports continuing for as long as there's that differential between the domestic and energy and international prices of natural gas. Here's exports, and this is value of exports, and as opposed to the prior graphs, we're going to be the volumes. And so this is price times quantity. So a lot of the fluctuation comes from price as well as quantity. But as you can see here, again, the U.S. is a big exporter of these products all over the world. Okay. So now we culminate everything into our employment forecast. And by the way, while I'm presenting the employment forecast culminating, I'm seeing there are a few questions here in the chat. Please feel free to ask any questions you would like, and we'll try to leave for a few minutes at the end in order for us to talk about them. So this is how the employment forecasts work. We really have two buckets. We have upstream oil and gas extraction and services, and then we have the refining and chemical manufacturing, and we do it for both Texas and Louisiana. The upstream oil and gas forecasts come from the value of production, which comes from the Prodcast. So in various Prodcast model, forecast the production of both oil and natural gas within the region. And then we multiply that production by the futures prices for those products for oil and gas respectively. And then we feed that into a statistical model that looks at the historical relationships between lag changes in the value of production and employment. And the refining and chemical forecast is fundamentally based upon the capital expenditure. So as we have capital expenditures that occur within these sectors, that is going to facilitate additional employment moving forward. So that's fundamentally how those models work. So let's look at the results. So this is the history of upstream oil and gas employment in Louisiana. As you can see, in 2024 was actually a pretty good year. And this is partially data that has occurred and partially the forecast. Also, please note that the current year's data will be revised, and I'll show you that here in a second. But before the 2014 price crash, we had about 50,000 workers in that sector. We lost about 18,000 during that 2014 price crash. Of course, that put Louisiana into a recession while the rest of the U.S. economy was expanding. We then had the pandemic dip that you can see there. And then we've kind of come out of that, but we're not anywhere near kind of that pre-pandemic peak, nor the pre-2014 peak. The good news in 2024, we're estimating about 1,200 additional jobs in that sector, which is really good. That's about a 4.5% increase that we estimate. In 2025, 2026, and 2027, we're kind of projecting that to be kind of flat. So we'll see a little bit more gain through the end of this year, and then it's going to kind of flatten out after that. And what does that come from? It comes from, again, the production that's coming online, but also that those prices are really, really in backwardation right now. And so that's pulling that in the future, that employment down. And it's those two counterbalancing things that get you a fairly flat forecast after 2025. This shows you the last several years, the employment forecast. And as you can see, if you look at the 2023 forecast, and you can see that the employment's significantly lower. And really what that's coming from, again, is those revisions that I was talking about in the data. So the data will be revised up to a year. And so that, in this case had a pretty significant impact and actually pulled the employment down relative to the forecast that we had because of those revisions. So that's not great news. You can look in Texas. This is what we see. So again, you can see the 2014 price crash, the pandemic. You notice that Texas still has this kind of more boom and bust, while Louisiana is more of like a stair step and is a little bit more steady. We attribute that a lot, of course, to offshore employment that's supported here in Louisiana, but also as the Haynesville's really a mature basin, and you're seeing more long-term planning going on there. Texas still kind of has that boom bust. Now, each one of the peaks, of course, has been lower. We're estimating that in 2014, Texas actually lost about 1.3 jobs, percent of their jobs, about 1% gain in 2025, and then again, kind of flat thereafter, even a little bit lower, again, because of those prices being in backwardation. So the bottom line here, we have more production. The podcast model is forecasting more production. And Chris alluded to this, but we simply need less workers to produce more hydrocarbons. And that's, of course, good for economic growth. It's good for consumers. But for people in those sectors, of course, that can be hard. And this is the forecast performance over the last few years from Texas. The share of employment in upstream in Louisiana was actually declining for many years until we had the pandemic, and now we've kind of flattened out again. And so this kind of just shows the stability of the Louisiana employment, those sectors. One of the things we look at is we look at the Federal Reserve, and they have their upstream, their business activity index, and you can see that's very flat as well. So this is consistent. This doesn't actually go into the forecast itself, but this is very, very consistent with what our forecasts are saying, as well as the Company Outlook Index, a great resource from the Federal Reserve Bank of Dallas that we lean on when looking at these forecasts. All right, now let's go to refining and chemical manufacturing. So we estimate that we gained about 3% employment in Louisiana in 2024. Again, part of that is a forecast. Part of that's the data, and keep in mind that revisions will occur. And we forecast that we'll continue to see gains over the forecast horizon here from about 1 and 1.5% per year moving forward. That has to do with the timing of these capital investments, as well as our smoothing that we do internally. So the bottom line is that refining and chemical manufacturing, we have surpassed that pre-pandemic peak, and we're forecasting that employment will continue to rise in those sectors as you have those investments. And you can see our forecast performance over the last few years in that sector there. So last year, our forecast did pretty well in terms of the forecast versus what occurred. And then this shows you for Texas. So again, we're forecasting an increase in refining chemical manufacturing employment in Texas, driven by the exact same phenomenon. You've got this capital investment. As those are continued, employment will increase. And you can see the forecast performance for that in Texas over the last few years. Again, we've kind of seen this kind of consistent, steady climb there that's occurred. So I'm going to kind of end with this. This is the Louisiana upstream employment relative to refining and chemicals. And as you can see, again, Louisiana employs more people today in that refining and chemicals than we do in the upstream. That's very, very different than how the state was historically, and is also very different than Texas, that still employs significantly more people in the upstream oil and gas sector than the refining and chemicals. So this just speaks to the continued theme of our outlook, which is these investments in the manufacturing of these products to export all over the world, that increasingly is becoming the kind of market that Louisiana is very important for us here in Louisiana. Upstream, of course, is still important, and having access to those feedstocks is enormously important for that downstream investment. But we're kind of unique in terms of the relative growth in that relative to the upstream. And this is corroborated when you look at the trade flows. So this is the number of indirect jobs with respect to the direct job in each one of these sectors. And as you can see, that that refining and chemical manufacturing actually have more indirect jobs per direct job. So this graph here that we show is actually even more exacerbated the importance of that refining and chemicals whenever you take into account those indirect jobs as well. So with that, this is our outlook. We thank you for coming today, participating. Here's the QR code to see the outlook on our website. It's also in the chat. And at this time, I'm going to ask for Chris and Andrew to come back on here, and we're going to go through the different questions that are here. So we've got a bunch of questions here in the chat, and so please go ahead and ask. Okay. So one person asks, we'd like to know the latest update on the new LNG plants in Texas and Louisiana. So we have a kind of policy here in our energy outlook to not talk about individual companies' projects for, of course, obvious reason if we would let those companies speak for those projects. But I can talk broadly about LNG. The thing that I really look at is in order to have a robust LNG sector, you really need for those international prices to be significantly higher than the domestic prices in order to justify the expense of course, shipping those internationally, which with natural gas is more expensive than oil. And that's exactly what we're seeing. We see that we look at the two international markers for gas, the TTF in Europe and the JKM in Asia. And both of those have a significant premium right now to Henry Hub here in the United States. And when we look at the futures market, that continues to be positive moving forward. So I think we're going to continue to see LNG export activity to the extent to which new projects will continue to move forward for capital investments. Of course, that's a little bit more trickier to forecast, but that is kind of the state of LNG. Okay, so Andrew, there's a question, and I have the same question when we talked about this initially. Did you actually say that this one project alone could be roughly 15 to 20% of the electricity here in Louisiana?
Yes. And I realize that sounds crazy, but if you look at what Entergy filed and make some assumptions about the size of this site and their Entergy stated need for new generation, they're proposing, Entergy in their filing, to add 3 new combined cycle facilities, 2 at the site in North Louisiana off of I-20, 1 in South Louisiana. The combined capacity of those 3 combined cycle gas turbine projects is over 2,000 megawatts. They've also proposed to add as much as 1,500 megawatts of solar. Depending on how you approach the problem, whether you go from the generation side or the potential size of the customer, you come back to something on the order of 15 plus million megawatt hours a year. And for perspective, Entergy New Orleans, for example, serves the city, Orleans Parish. They have more than 200,000 customers. Their peak load is about 1,200 megawatts. So you're talking about capacity-wise, probably 2 city of New Orleans size customers. And then from an energy usage perspective, a higher load factor. So perhaps as much as 3 times the consumption of Entergy New Orleans at a single site. So yeah, the size of it is just mind-boggling. And it really goes to kind of a discussion Greg and I had about data centers and how lumpy they are. And assuming that they're all going to be 50 to 100 megawatts, very uniform looking, kind of gets to the analysis around on a national level, how many data centers, but you have these hyperscale AI data centers that are now being proposed. There's one in Mississippi that's in excess of 1,000 megawatts based on public data. There's one in Ohio that Amazon has proposed that is 1,500 megawatts. So the scale is just beyond anything from an industry perspective that anyone can comprehend. I mean, much larger than a typical refinery, if you want to kind of put it into some perspective. There's a question that follows, I think, that's germane, but probably not easy to answer. And that is, well, how are you going to power this? So I mentioned that Entergy's proposed 3 new combined cycle gas turbine facilities. The question is, would you need another nuclear plant in the state of Louisiana or perhaps South Arkansas? In the near term, that would be challenging principally for economic reasons, but also from a time perspective. The timeline to receive approval and construct a nuclear unit is in many, many years, much longer than the timeline to construct combined cycle facilities. That's not to say that there's not rapid growing interest in nuclear. There's been a number of announcements. This is changing so fast just in the past month or two around both Microsoft, Amazon, Meta, Google, all announcing varying partnerships with advanced modular nuclear reactor manufacturers, as well as owners in the Northeast, for example, of existing units. So a lot will change in the coming years if these types of data centers come to fruition, and there may be a need for nuclear generation in the Gulf states. Whether that's going to be 2030s, we'll have to see. It certainly would take longer than, by 2030 to have that come together.
Awesome. So David Mitchell from The Advocate always asks very intelligent questions. We hear that some LNG exports have the chance of driving up energy prices for consumers domestically, and asks us to opine on that critique. So I think that, let's just go to Econ Theory 101. You can say, okay, well, suppose that you have a market that's in equilibrium, and all of a sudden there's some source of demand that's internationally, of course, holding the supply curve constant. You shift that demand out by having that international market, and that will certainly lead to an increase in prices for domestic consumers. I think that basic models probably asks two questions that I would ask to expand. Number one is, well, what is the effect of that? What is the magnitude of the effect of that? And number two, if it wasn't for these international markets that are there, what would have been the energy development that we would have had in the United States, kind of the longer term planning of the capital that's spent and everything like that? So certainly, I think in the short run, definitely could lead to increases in prices. I think that the export activity in net has certainly benefited our part of the country, the Gulf Coast region, and probably the effect on prices in the long run are probably relatively small. You also asked, can you speak more about the impact of the new administration will have on credits and incentives for energy transition projects? What will the scalpel cut? What kind of effects do you expect to have on any announced projects? CCS, hydrogen, solar, etc. So you're asking the exact same questions that I am answering, asking the same questions that I'm asking. I think I've saw Elon Musk come out and make some comments on EV tax credits are not needed. So it'll kind of be interesting to see what that happens with, obviously the largest EV manufacturer and the CEO being, part of the new administration with his DOGE program, et cetera, stating that. So that would seem like a logical one to look at. You look at the 45Q. Every indication that I've got is that the current leadership in Congress is supportive of the 45Q, especially Louisiana. This is important to us, and we obviously have, a lot of influence there in Washington. The 45V tax credit for hydrogen, to me, is a bigger question in that the current rulemaking for 45V is not yet completed. There's a lot of uncertainty about what that rulemaking is. So we could really, I think, kind of going back to the drawing board with that in a way that a lot of the people in industry might actually like the 45V updates from the new Trump administration. But of course, delaying that could also add delay. I can tell you that last week in the hydrogen task force earlier this week in the hydrogen task force, we had one hydrogen company come and speak in front of the task force and was asked this exact question. And they actually said that it was 45Q that was going to be important to the economics of their project and not 45V. And I think that's been consistent because of the delay in that. So that's some commentary, but of course, we will be watching that closely to see. Okay, so I've heard that carbon transition goals for the upcoming decades are deterred development and maintenance investments in plants that produce downstream petro products. Given the nature of importing, refining, exporting pattern, do you think that there's been a reduction in the investment in these energy manufacturing sectors due to these decarbonization investments? That's a hard question. On one hand, if we have customers all over the world are telling the companies here, and I hear this from the major oil companies, the major chemical companies, that they are actually pitching that our carbon intensity being competitive to a lot of the competitors in the world is actually a comparative advantage for us, at least in the short run. Of course, and we're seeing that with all the investments coming forward. In the long run, that's a kind of way harder question to ask. Would you see, companies moving away from divesting from assets that are more carbon intensive? I think so. I think in the short run, I think in the net, we've seen increased economic activity due to these transition investments, but the subsidies as well as the customers globally telling the local companies that they want that. But of course, in the long run, that's going to be more difficult. Okay. Okay, question for Chris. What are you seeing in terms of geothermal opportunities here in Louisiana?
Chris, you're muted.
Maybe I represent other people here in that the definition of what I had always considered to be geothermal is changing, and that I had always considered it to be taking very hot water from the subsurface and driving a steam turbine with it. That now geothermal can be considered simply injecting water underground as part of an HVAC system for an individual building. And there are also considerations of changing the types of fluids used in the energy transfer. So you don't have to get the temperature to boiling point to take advantage of higher temperatures from the subsurface. I'm not aware of any of that activity taking place in Louisiana, but I have had conversations with professors in the petroleum engineering department here, and it is certainly being considered in the aspects of research.
Awesome. All right, and we're out of time, but I'll ask the one last question here. We have a question about SMR, Andrew. I know you were in a meeting about this yesterday. Do you have any thoughts on SMR, small modular reactors, being important for industrial decarbonization, perhaps having a play in the electric grid?
Yeah, so real quick, I know we're out of time. There is a partnership or maybe some kind of MOU between Dow Chemical and one of the SMR manufacturers that is looking at a site in Texas that would be a host, an industrial facility for a small modular reactor. That's been under development for years. There's a number of steps that those entities would have to go through at the NRC to get licensing, but a lot of that is in play. What's really interesting in just the past month or two are these announcements with data centers, with the big tech companies saying, me too, me too. And it really gets to the pace of constructing infrastructure, transmission and generation, and the need for decarbonization and the potential for small modular reactors located at data center sites that might be in the next, say, 7 or 8 years. So nothing that's happening next week or next year or in the next couple of years, but in the next 5 to 7 years, there may be a play there where that makes sense from an economic perspective as well as a carbon reduction perspective to locate an SMR unit. That will be very interesting to see as a development. If you imagine, consumers today that are reducing carbon emissions in their bills through rooftop solar, this would be analogous, but obviously much different technology and on a much larger scale.
Well, I want to thank everyone again for attending. This is my favorite thing to do every year is this Outlook, just getting to talk to so many people. I feel like I learned so much doing this. Chris and Andrew, I had so much fun working with you guys on this year as well. So thanks everyone for attending, and hopefully we'll see you before next year's Energy Outlook kickoff.
Thanks, Craig. Appreciate it.